What happens when the company selling the shovels starts helping finance the gold mine? Nvidia is best known for making the chips powering the artificial intelligence boom. Increasingly, selling those chips requires something else. Someone has to finance the enormous infrastructure needed to use them. Welcome back to Synthetic Politics. Nvidia has agreed to provide up to $105 billion in guarantees, supporting OpenAI's 20-year lease of a massive Ohio data center campus being developed by SB Energy. Nvidia is also investing $1.5 billion in SB Energy and will be the exclusive supplier of AI computing hardware at the facility. Nvidia isn't simply handing OpenAI $105 billion. The guarantees cover specific lease and residual value risks if OpenAI cannot meet its obligations. They do not guarantee the entire project. That distinction matters. A specialized AI data center can be enormously valuable when its intended customer is using it. Lenders also have to ask what that facility would be worth if the customer stopped paying. The more specialized an asset becomes, the harder it may be to find another buyer or tenant willing to pay the same price. Economists call this asset specificity. That uncertainty creates risk for the people financing the project. Nvidia can use its balance sheet to absorb a defined portion of that risk, making the infrastructure easier to finance. So, why would a chip company take financial risk on its customer's data center? Because the customer's financing problem can become the supplier's sales problem. OpenAI may want enormous amounts of Nvidia hardware. Those chips generate revenue only if someone can finance the buildings, electricity, cooling, networking, and everything else required to deploy them. If the infrastructure cannot get financed, Nvidia cannot sell as many chips. Economics has seen related problems before. In 1919, General Motors created GMAC. Many Americans couldn't afford to pay cash for cars, while traditional lenders were reluctant to finance automobile purchases at scale. GM helped provide financing that allowed more customers to buy its products. The same logic still exists today. Caterpillar has operated its own financing business since 1981. Its customers often need expensive machinery they cannot comfortably purchase outright. Financing that equipment helps support Caterpillar's equipment sales. The product changed. Cars became bulldozers. And now bulldozers have become data centers full of GPUs. The underlying incentive is familiar. When customer financing constrains demand for your product, helping solve the financing problem can become part of selling the product. Nvidia's arrangement is different from GMAC or Caterpillar Financial. It isn't simply giving OpenAI a conventional equipment loan. The economic logic, however, is similar. Nvidia can use its financial strength to absorb risk that others might otherwise have to carry. That can help make more infrastructure financeable. And more infrastructure creates more demand for Nvidia hardware. Guarantees do not eliminate risk. They move it. If OpenAI performs as expected, Nvidia may never make substantial payments under the guarantees. If OpenAI cannot meet its obligations and the facilities prove less valuable than expected, some of that downside can land on Nvidia. And some of these risks may be correlated. Nvidia benefits when demand for AI chips is strong. The value of specialized AI infrastructure may also depend partly on continued demand for AI computing. So, Nvidia is taking additional financial exposure to an ecosystem whose success already drives much of its business. Some observers call arrangements like this circular financing because suppliers, customers, developers, and investors become financially intertwined. Nvidia CEO Jensen Huang rejects that characterization of this deal, emphasizing that OpenAI is responsible for paying the lease. We don't need to settle that debate to see the economics. Nvidia is accepting a defined portion of the project's downside risk while helping expand the market for its products. That's another layer in the AI economy we've been watching develop. Financial institutions are finding new ways to mobilize capital. Hyperscalers are borrowing at enormous scale. Now a major supplier is using its own balance sheet to help make customer infrastructure financeable. The AI boom isn't only changing what companies build. It's changing how some companies allocate risk around what they build. And underneath all of it is a basic principle of finance. Risk can be transferred. It can be shared. It can be priced differently. It cannot simply be made to disappear. Do you think Nvidia taking on more financial exposure is a smart way to expand the market for its chips? Or does it create too much risk if AI demand disappoints? Let us know what you think below. If this breakdown was useful, hit like and subscribe to Synthetic Politics. We'll be back when there's more to report.